Did you know house prices across Europe rose by 4.5% at the end of last year?
But our disposable incomes, that's the money you and I have in our wallets to actually spend, hasn't increased anywhere close to that level. But with low interest rates and pretty easy credit conditions compared to the past 10 years, it's about time we ask ourselves, how are our households and our economies impacted by our homes?
Mike and Natalia have bought a home. Their jobs and income are stable. The economy is growing, interest rates are low, and banks are lending. Rising home prices means the couple's equity in their home is rising too. But if prices start falling, their investment will have a lower value, leaving them owing more than their house is worth. If their country's banks own a lot of mortgages, the collateral they hold will have less value. That means they'll also have less money to lend to the broader economy. The couple will have to spend more of their earnings on their mortgage and won't have money for other things they need. If they can't spend on adding value to their home, Mike's job will be at risk since the construction industry will slow. If Natalia cannot spend on other goods and services, companies like where she works may have to cut jobs to make up the earnings loss. Losing either or both jobs could mean Mike and Natalia won't be able to afford their home.
When house prices rise consistently like they did in Sweden till the end of last year, it brings up concerns of whether our homes are overvalued and if that puts unnecessary burdens on households for the debt they need to afford them. Now, house prices are rising across Europe, but they're coming off a low base after steep falls like in Portugal and Ireland. So Guillaume Desjardins set out to find out what happens when a country like Sweden starts correcting.
Since the subprimes crisis 10 years ago, banks have had to increase their solvency ratios in order to reinforce the banking system. But for households dreaming of getting the keys to a new home sweet home, that makes getting credit a lot more complicated. Yet in recent years, property prices have risen faster than wages. And in spite of everything, households have indeed had to take on debt. Sometimes high levels of it. Like here in Sweden, where for more than a third of households, debt represents more than 4.5 years of salary.
We have seen some regulations that has made it harder to, for example, get a loan on the market today. The new regulations was implemented 1st of March this year in 2018. And we have seen since then that, for example, bigger households, bigger families are more affected. They have a harder time to buy, for example, bigger apartments.
Lately, Sweden's taken steps to clean up its housing market. A buyer now needs a down payment of at least 15% of the purchase price, and each year they must amortise, that is, pay off part of the loan. Banks too have started giving more weight to mortgages in their risk assessments. A lifesaver in the face of economic risk. High debt may indeed be difficult to pay off for the most modest of homes, but the same goes for others too, with each regular payment reducing the daily budget. Over recent years, high property prices together with a high debt ratio have put a strain on the budget of Swedish households, as well as on their ability to become homeowners. But it's also had consequences for the economy as a whole.
That will be sustainable as long as interest rates are low. But the question is very important, what happens when they rise? And obviously what will happen is that a lot of households will have to draw back on other things. They will have to save on anything from restaurant visits to what have you, vacations, in order to pay higher interest rates. But a few households will, of course, be in bigger trouble than that and will be needing to leave their houses. But we think that's a bit far off, though.
The European risk regulator, the ESRB, has warned Sweden and 7 other European Union nations about 2 dangers they're exposed to: property debt that's too high and homes that are overvalued. A bump on the property market can impact the whole economy.
Bumps like these hit the middle class and the poor the hardest. So I've come to Lyon in France to understand what the man who heads up 43,000 housing providers in 24 countries thinks of the signals we're getting from the market.
Cedric, we set you a challenge of bringing an object that defines what Europe's housing market represents to you. What did you bring?
I brought 2. Sorry I didn't stick to the rules. The first is keys, what every European citizen wants and expects. Housing in Europe is crucial for all European citizens, but more and more are unable to find a house in keeping with their income and their job or family situation. Social housing and stakeholders of social and affordable housing have a bad image. A year and a half ago in the Netherlands, in Amsterdam, a team said we should organize a social housing festival to show all of its diversity, what it brings to our economy, to our territories. And I'm delighted to tell you that it will be held again in 2019 here in the Greater Lyon area.
What worries you more, properties being overvalued or the fact that household debt is so very high?
The problem in Europe today is that house prices have increased much faster than citizens' incomes. 1 in every 10 Europeans spends more than 40% of their income on housing. It's an indicator of a scale of effort that's too high. In other words, you're spending too much money on housing, and that's an extremely alarming indicator. And the second element that alarms us is that this rate is increasing even more for the poorest households.
Do you think the banking regulations that have been put in place are enough to address the issues that may arise?
The situation is somewhat paradoxical, with accessing credit from the bank in order to buy. The rates are low indeed. These low rates boost price hikes. But at the same time, banking requirements when it comes to lending to citizens wanting to buy are considerable. So in the end, this market of accessing mortgages today favors the richest, not the poorest, because this cheap money is not accessible to, let's say, those who need it most, especially for the youngest households and the most vulnerable households.
How do you see the situation here in France compared to other parts of Europe? Because here prices seem to have more or less stalled outside of the Paris area.
You're right, the average indicator in France has rather stabilized, but the problem in Europe is the gap being created between attractive territories and those that are less attractive. I'll give you a figure. We're here in Lyon. In this city, the price of housing went up by 69% between 2010 and 2015. That's enormous. We've returned to annual rates of increase in house prices that are very close to what we had in 2009. So here we have an example very close to us that, in our opinion, is in the process of happening again if we're not vigilant and if we don't put in place regulation mechanisms to avoid a new housing bubble in Europe.
Cédric, thank you very much on that note for your insights, and thank you for watching. We'll catch you next time.